Hey everybody, welcome back to Actual Investing. Today I want to talk about two companies that have been really popular lately among the investing community, and those are Chewy and Rivian. I talk a bit on my channel about how I like to avoid risks as much as possible, so I tend to focus mostly on larger, well-established companies. However, today's companies are the type of high-risk, high-reward company that I think a lot of my viewers like to learn about, so I'm going to talk objectively about both Chewy and Rivian and see if either of these would be a buy for a high-risk investor. So let's start with Chewy. What's going on with Chewy? As strange as it seems, it kind of started with this tweet by a Twitter account called Roaring Kitty. If you're not familiar with Roaring Kitty, his name on Reddit is something that's a bit more obscene, and he is the one who essentially spearheaded the GameStop stock rally back in 2021. This is an SEC filing that Keith Gill, otherwise known as Roaring Kitty, filed, which discloses his 6.6% stake in Chewy. So he is a pretty wealthy man, and he is betting big on Chewy. If we dig into this a bit, Keith Gill, or Roaring Kitty, says that this is a bet on Cohen, who is the CEO of GameStop. If we look at Ryan Cohen's bio, he also founded Chewy. So this makes sense. If Keith Gill is bullish on Ryan Cohen, it would make sense that he's also bullish on Chewy, and the investment sort of aligns with those philosophies. So let's just ignore all of this meme stock stuff and look at Chewy and their financials and see what's going on with the business. If you're unfamiliar with Chewy, or if you're not from the US and maybe you've never heard of Chewy, essentially they are an e-commerce pet retailer. So you can buy pet food, pet medications, pet toys, any kind of pet supplies online. They'll have it shipped to your door. They do compete with companies like Amazon, but as a specialty retailer, there are certain things you can find on Chewy that you simply just cannot find on Amazon. So this is Chewy's most recent earnings presentation, and first of all, I like that they put together an earnings presentation. That's really nice from an investor relations standpoint. One thing that's interesting is that they've announced their first share repurchase program, and that's quite refreshing to see because here's a chart of Chewy's shares outstanding over time since their IPO. We can see that it's been on a steady upward trend over time. So the fact that they are now buying back shares is probably a vote of confidence for investors who have been waiting all this time and have been getting diluted, honestly. When we look at sales, we can see that revenue growth is really kind of trailing off, which is unfortunate. Full year revenue growth was up in the last 12 months, that's LTM, 7.2%, which is respectable. However, on a quarterly year-over-year basis, it's only up 3.1%. So one could argue that that's just keeping up with inflation. Now, Chewy's not really priced like a growth stock. Here's another page of my spreadsheet that I don't often show. I call this the high quality companies spreadsheet. And essentially I look at 11 different factors instead of my normal 4 factors to analyze companies. I usually put companies on the sheet if I'm doing a bit more of a deep dive and thinking about investing in them. So the 11 factors that I look at here are market cap, gross margins, selling general and administrative to gross profit, research and development to gross profit, debt to equity, percentage of sales that come from out of the country, international sales, price to annualized sales, revenue growth, dividend yield, PE ratio, and moat, which is assigned by Morningstar. That one I don't pay as much attention to. It's just kind of nice to see what other people think. So when we look at Chewy, we can see that they're really not priced like a growth stock. They have a price to annualized sales of 1.1, and that's even after this recent run up. So Chewy, not necessarily expensive if you were considering them a growth stock, but if you were looking at them like a value stock, we see that they have a PE ratio of 141. So Chewy is quite an odd stock to analyze. Growth investors will say, well, there's no growth, so I'm not buying. And value investors will say, well, it has this massive PE ratio, so I'm not buying. So I think that's another reason why Chewy has performed so poorly before this whole Roaring Kitty announcement. So anyway, if their sales growth is flatlining, we would expect them to become more and more profitable over time because they should be cutting down on the SG&A expense. However, in the trailing 12 months, they actually spent most of their gross profit, 99%, almost their entire gross profit, on SG&A, selling general and administrative. So I don't really love to see that. Typically, if you're spending a lot on SG&A, I would be expecting you to grow, you being Chewy. And if you're not growing, I would expect to not be spending so much on SG&A. So the fact that they are spending a lot and not growing, I don't know. I don't really love that look for Chewy. Okay, so that was a bit of a bear case. Let's talk about auto ship. One of Chewy's unique value propositions is that a significant portion of their customers are actually on auto ship, which means that they don't have to do anything. And every month, 6 weeks, whatever they set it up, food, prescription medicines, those types of things will just show up at the customer's door. So that's really slick, and it really helps with their growth because they don't have to go out and fish back in these customers. They're already locked into a recurring program. So what's nice to see is that this has also been growing. However, sort of like revenue growth, it seems to have kind of flatlined in the recent years. Year-over-year revenue growth of Autoship customers is just 6% for the previous quarter. By the way, if you're new to the channel and you're liking what you see so far, please like the video. That really does help with the YouTube algorithm. I think it pushes it to more people on their explore page or whatever that homepage is called. And please subscribe if you're new too. I post stock deep dives and general stock analysis videos. So if that's something you like, please subscribe. I would love to have you along for the ride. Another metric that they supply, which I really like, is this NSPAC, or net sales per active customer. This is similar to ARPU, or average revenue per user. And it looks like that has been, steadily increasing still. So year over year, we see that they are increasing their revenue per customer. However, Chewy is a retailer of pet products, so most of this increased revenue per customer is probably coming from the manufacturers of the products. So for me, I've noticed that dog food has just increased dramatically in price over the past few years. I think I used to pay something like $40 for a certain brand of dog food, and now it's up closer to like $60 or $70. So it really, really has significantly grown. So even though this is trending in the right direction, I think a lot of this is coming from simply just price increases. And I don't know how much you can continue to do this going forward. Another thing that I like to see is that their gross margin here is increasing, and this you can kind of undoubtedly see is up. So their gross profit was up from, in the first quarter of 2023, about 800 million to about 850 million in the first quarter of 2024. So that's awesome that they are increasing their gross profit. This shows me that they are successfully transitioning from a growth stock to a value stock, essentially now focusing on profit growth versus revenue growth. Another metric going in the right direction is their adjusted EBITDA, which is raising year over year. And again, we like to see that. EBITDA, for those unaware, is earnings before interest, taxes, depreciation, and amortization. And it's a pretty generally accepted profitability metric. And now for the bad news. Free cash flow is on the decline, unfortunately. If we look at this, the last 12 months, free cash flow was down significantly from fiscal year 2023. And in the most recent quarter, free cash flow was cut in half from the first quarter of 2023. So I don't love to see that free cash flows are on the decline, even though gross margin is on the incline. In order to figure out why cash flows are on the decline, I simply pulled up their recent press release and searched for the term cash flow. And I found this nice little chart, which shows their cash flows in the first quarter of 2024 versus the first quarter of 2023. We can see that two things happened. Their capital expenditures increased. Think things like factories, facilities, large purchases. And net cash provided by operating activities was actually significantly down year over year. So what we're seeing is twofold. They're making less operating income and they have more capital expenditures, and that's why free cash flow was down so significantly. Is this temporary? Is this going to be a long-term concern? I'm not sure, and I think that's one of the reasons why Chewy stock was also being hammered recently. So let's look forward because, like I said, Chewy's not really a growth stock, it's not really a value stock, but we should still look at what the company is planning to do this year. It looks like they're looking at net sales of 11.6 to 11.8 billion, which is 4 to 6% year-over-year revenue growth. Again, that's just barely keeping up with inflation, so that's not really anything too encouraging for me. When I see their free cash flows trending the wrong way and the revenue growth seems to be flatlining, I'm no longer interested in Chewy. And even though I called it a cheap stock to buy in a previous video, I have since sold Chewy and I no longer find it to be a cheap stock to buy, unfortunately. However, maybe Roaring Kitty, aka Keith Gill, will be able to get in and use some of his 6% ownership to have a little bit of leverage in the company and be able to turn things around and get this company back to growth. One thing that is going to help out Chewy, which I didn't mention, is that they are expanding into Canada. So that's going to be a new growth opportunity for the company that traditionally has operated just in the US. So look for that if you are an investor in Chewy. With that said, let's head on to Rivian. And I love this Bloomberg article. The title is "Rivian is embraced by a needy German sugar daddy." And I just think that really sums up what is going on with Rivian. So essentially, Volkswagen has agreed to invest anywhere from $1 to $5 billion into Rivian. And they're already looking to put that money to good work. It sounds like they're planning to launch 5 new models of Rivian vehicles after the $5 billion Volkswagen investment. So just a bit of background, Rivian is an electric vehicle maker. They compete with the likes of Tesla, and they recently announced that VW Group, which is Volkswagen, a German car company, would invest, this says $5 billion, it's actually up to $5 billion into Rivian. If you look at the fine print, they've only committed to about $1 billion with up to $5 billion over time. So it's really important to read that fine print. However, let's just, for all intents and purposes, call it $5 billion. And here are the 5 covered up cars that they are planning to unveil now that they've gotten this extra Volkswagen money. Rivian is a really hard stock for me to value because when I look at my typical metrics, a lot of them just simply do not apply to Rivian. Rivian has negative gross margins, which means they're selling each car for less than it costs to produce. This is temporary, and Rivian is planning to turn a profit, but it means that these 3 buckets I can't really analyze, and I also can't analyze their PE because they're not profitable on a net basis or a gross basis. What I do see is that they're growing revenues 80% year over year, which is insane, amazingly fast, and they have a price to annualized sales of 2.6, which is incredibly low for a growth stock. So essentially, the market is really discounting Rivian because of their poor profitability metrics. When we look at their most recent earnings release, we do see that the CEO is focused on profitability. One of the first things he comments on is that he is focused on driving, no pun intended, I'm sure, right, towards profitability. So what does Rivian have going for them? Well, this is a chart of the US EV market share by company, and obviously Tesla is the biggest player in the space, so it makes sense that they have over a 50% market share at 56.3, but Rivian is up there at 3.7% market share, and Rivian is a significantly smaller company than Tesla. When we think about Tesla, they're a roughly $500 billion company, Rivian just a $15 billion company. So the size is kind of proportionate to their market share just a bit. What else does Rivian have going for them? Well, like the CEO said, they are driving towards profitability. So let's see how they plan to do that. Here's a page from their shareholder letter. If you know me, you know I love a good shareholder letter. And in their drive towards profitability, Rivian talks about a retooling upgrade. So they expect significant improvement in the material, depreciation, and conversion cost of their vehicles, and they remain confident in their path to achieving a modest gross profit in the fourth quarter of this year. So that's great. So they plan on having positive gross margins by the end of 2024. That does seem quite ambitious because in the trailing 12 months, they had negative 40% gross margins. So they really do have to turn this around, but it sounds like they do have a plan to do so. Here's an article that talks about Rivian's path to profitability. It sounds like part of the reason for their negative gross profit is costs that are linked to getting ready for a second quarter plant shutdown and production line revamp and supplier changes. So Rivian is pivoting. They also talk about negative impact from Amazon. So it sounds like Amazon slowed acceptance of new delivery vans, focused instead on holiday deliveries in the most recent earnings release. This was at the end of last year, by the way. For example, Rivian said Amazon made up only 8% of fourth quarter of 2023 vehicle deliveries, down from 30% in the third quarter. So it sounds like Amazon is slowing, and Amazon is Rivian's biggest customer. So that's part of the reason why they still have such a negative gross profit. So if we believe that Amazon is going to continue to ramp up purchases of delivery vehicles, that might be a good thing for Rivian. Some other tailwinds that they have are this new R2, which is going to be released. It's a new, less expensive Rivian vehicle. They've been able to renegotiate and remove the price premium for parts they had to pay as a new company. So it sounds like as they become established, they're able to lower their costs, which are also going to be good for their gross margins. And one other tailwind is that lithium prices are down. CEO says lithium hydroxide is down by about 4 times, from north of $80 per kilogram to just over $20 a kilogram today. So that has a very significant impact on our overall cost structure. And indeed, that is true. If we look at a price chart of lithium carbonate, we can see that it peaked back in the end of 2022 and has just been steadily declining ever since, and is now back to the lows that we saw back in 2021. So that's really nice for EV manufacturers. It's going to really help them to squeeze out a bit more of a gross profit. All right, so those are my thoughts on Chewy and Rivian. To conclude, I don't own either of these stocks. I did used to own Chewy, but I don't own Chewy anymore simply because I don't see the company progressing in either profitability or a revenue growth standpoint. And just at this point, I think there are better opportunities out there. For Rivian, I think if you are an investor who can handle a bit of risk, this cash from Volkswagen certainly gives them a bit more runway, which is definitely a concern when you're a cash burning company. And the fact that they are planning to become gross profitable by the end of this year is encouraging. So maybe that would be one to potentially look at picking up if you do have a strong appetite for risk. However, there's just too many red flags, and I personally cannot invest in it. It does break my negative gross margins rule, and it's just simply too speculative for me. I don't know for a fact that they're going to be able to turn that gross profit. And even when they do, I'm not sure that they're going to be able to become free cash flow positive by the time they run out of money. They do burn quite a bit of cash. So I'll be on the sidelines for both of these stocks, but I hope that this helps you in doing your own DD and your own research on both of these trending stocks today. Some upcoming videos that I have, I'm going to be talking about DXYZ, which is the Destiny Tech 100 fund, so stay tuned for that. And I also plan to analyze a subscriber's portfolio. So if you are a subscriber and you want to submit your portfolio for me to review, please email your portfolio details, no actual dollar amounts, just percentages, to actualinvesting@gmail.com. That's all one word. I can put it in the comments below. And I can take a look at your portfolio, and I'm just a guy on the internet, but I would love to take a look at your portfolio and maybe roast it, maybe talk about what you're doing well, what I don't like, and what I do like. So if that's something that interests you, please email your portfolio detail without any personally identifying information to actualinvesting@gmail.com, and I will plan to put together a video where I talk about my subscribers' portfolios. Thank you guys so much for watching the video today, and I hope you all have an awesome day.